You know how sometimes you try to recreate a dish just from taste?
Oh, yeah.
Like maybe your grandma's cookies. You kind of remember the ingredients, but you can never quite get it exactly right.
It's never the same.
Right. Well, that's kind of like parameter optimization in finance. It's all about finding those perfect ingredients for a trading algorithm to make it really sing.
It's a great analogy.
And this deep dive is all about that optimization. You shared some super interesting research with me from QuantConnect.
I did.
It really got my brain going. They took a look at that iShares Top 20 U.S. Stocks ETF, TOPT, the ticker symbol.
Right.
Basically, it tracks the 20 biggest companies in the S&P 500. So, a pretty solid bet on market giants.
Exactly. Just a simple strategy rooted in the idea that larger companies tend to do well, over time.
Yeah, long haul.
Yeah.
But here's where things get really wild.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
QuantConnect, they tried to beat TOPT, which is already a pretty strong benchmark, but they did it by just changing 2 parameters. Just 2. That's what blew me away. I was like, wait, you can make a big difference with just tiny little tweaks.
Yeah, it's amazing the power of optimization and algorithmic trading. Subtle adjustments, big ripple effect.
So spill the beans. What were those 2 magic levers?
Okay, so first, they looked at what's called the lookback period. Now, stay with me on the baking analogy here.
I'm here for it.
Okay, so it's like deciding how long you let dough rise. Too short, and you miss out on all that fluffy goodness. But leave it too long, it's going to be dense, unusable mess. In an algorithm, this parameter decides how far back in time the model looks at data.
Okay. So finding that sweet spot between like too much old data and too much new data.
Yeah, exactly. Balancing the historical context with recency bias.
Okay, I'm with you.
And the second parameter, universe size.
Okay.
So if lookback period is like how you let the dough rise, universe size is like what size pan you're using.
Okay, I like it. So are we talking about how many different stocks the algorithm is considering?
Bingo. So you got to decide, do we go for a huge, massive universe of stocks or a smaller, more focused group?
I feel like intuitively I'd say more options is better.
Right. More is always better, we tend to think.
Yeah.
But think about it. You wouldn't bake one tiny cookie in a huge industrial oven, would you?
No, that'd be ridiculous.
Right. That's what I'm saying. A massive universe of stocks might dilute the algorithm's ability to zero in on those golden opportunities.
Okay, I see what you mean. So how did QuantConnect go about finding the right combination of look-back period and universe size? Like, what was their process?
They were super systematic about it, very data-driven. They tested a bunch of different combinations.
Okay.
Look-back periods, universe sizes, measured how each variation performed.
And how did they measure performance?
Well, they used what's called the Sharpe ratio.
Yeah, for those of us who aren't, finance PhDs, what's the Sharpe ratio? Tell us.
Basically, how much return are you getting for every unit of risk you're taking? So higher Sharpe ratio, generally better.
Okay, so it's not just about does this recipe taste good?
Right.
But will I burn the kitchen down trying to make it?
Yeah, pretty much. You got to manage the risk, not just chase returns.
Okay, so what did they find? What was the magic formula to beat those market giants?
Okay, this might surprise you. Their research shows smaller universes and shorter look-back periods. Those often performed better than their bigger, more expansive counterparts.
Wait, so less is more? You're telling me less data, fewer options, actually better results?
It's kind of a paradox, right? Yeah, it really challenges this idea we have in finance, like more is always better.
Right, like the more data, the better, the more choices, the better.
Exactly. We think more data, more options, going to lead to better decisions, right?
Right.
But sometimes maybe it just creates more noise and you can't see the signal.
So it's not just about how much data, but the quality of the data.
Totally.
Like trying to find a needle in a haystack. Bigger haystack, harder to find the needle.
Exactly. And that brings us to this idea of overfitting, which is really important in algorithmic trading. It's like if you had a cookie recipe, right?
Yeah.
But it only works with one specific brand of flour and a very particular oven temperature. Even like the humidity has to be just right.
Oh, wow. So very specific.
Super specific. It might make amazing cookies, but only under those exact conditions. Change anything. It's a disaster.
So like an overfitted algorithm, it works great when you're testing it on historical data.
Yeah.
But then in the real world, market changes. It falls apart.
Exactly, exactly. So by narrowing the universe size and shortening the look-back period, QuantConnect might have accidentally avoided that overfitting trap.
Okay.
So the algorithm is less sensitive to all the little quirks of the past
Interesting.
and more tuned into what's happening right now in the market.
I see. But I'm still kind of stuck on this look-back period thing.
Yeah.
Like if you make it shorter, wouldn't that make the algorithm miss out on like important long-term market cycles?
It's a good point. It's definitely a trade-off. But remember, we're trying to beat TOPT. And to do that, maybe recent market behavior is more important than those long-term trends.
Right, right. Especially with how fast things change these days.
Absolutely. Markets are wild.
Totally.
Unprecedented volatility. And to go a little deeper into QuantConnect's research,
Yeah.
they didn't just stick with market cap. They also played around with other metrics like the Sortino ratio.
Okay, the Sortino ratio.
Yeah.
So we talked about Sharpe ratio. How's the Sortino ratio different?
So Sharpe ratio looks at all volatility as bad. Sortino ratio, it zooms in on downside volatility, like the really bad swings that make investors nervous.
Okay, so back to our analogy. It's not just about if I'll burn the kitchen down.
Right.
It's about how bad the burns will be.
I like where your head's at. So by using the Sortino ratio, QuantConnect was basically looking for even better ingredients for their recipe.
So maybe finding some hidden gems, stocks that a simple market cap approach would miss.
Exactly. And to show you how much these parameters matter, the research found a portfolio with the top 50 stocks.
Okay.
And a 6-month look back got a Sharpe ratio of 1.2.
Okay.
But if you go to 200 stocks and a 2-year look back, Sharpe ratio drops to 0.8.
So smaller universe, shorter look back, much better risk-adjusted returns.
It's pretty convincing.
It is, it is.
And it challenges this fundamental idea about diversification, you know?
The whole don't put all your eggs in one basket thing.
Exactly. We think spreading your bets reduces risk.
Right.
But QuantConnect's findings suggest, at least with algorithms and with these large cap stocks, maybe concentrated bets actually do better.
Wow. So what does all this mean for, the average investor? What should we take away from all of this?
I think for me, the big takeaway is how much power these parameters have.
Yeah.
Like just small changes to the look-back period, the universe size. It can make a huge difference in how the algorithm performs. Kind of like, that pinch of salt.
It's true.
Yeah.
Small tweaks, big impact.
And it also makes you think twice about diversification.
This idea of a smaller universe, a more concentrated portfolio, kind of goes against what we've always been told.
It does. It really challenges that conventional wisdom. But when you're dealing with these really sophisticated models, huge amounts of data, maybe that laser focus is more effective than trying to cast a wide net.
It's like if you chase 2 rabbits, you'll catch neither. Right?
Exactly. You need that singular focus.
So for our listeners who are maybe thinking, okay, this all sounds cool, but where do I even start?
Yeah.
What would you suggest?
Well, first things first, check out the full QuantConnect research.
Okay.
We'll put a link in the show notes.
Perfect.
It really dives deep into how they did it, the results they got.
And for people who, maybe aren't super comfortable with all the technical stuff, are there resources out there that explain, like, factor investing, parameter optimization?
Oh, absolutely. Tons of great books, articles, online courses.
Right.
They break down these concepts in a way that anyone can understand, even if you don't have a PhD. And I'd say don't be afraid to experiment. There are platforms where you can actually test different strategies. Play with the parameters, see how it all works.
It's like your own little trading lab.
Exactly. You can test out your ideas, refine your approach, really get a hands-on understanding.
I love that.
Who knows? You might even discover something groundbreaking.
Yeah, you never know.
Always more to learn.
Absolutely. So as we wrap up here, what's that one thought you want to leave our listeners with today?
So if just changing the number of stocks in your portfolio can lead to better returns, what other commonly held beliefs about investing should we be questioning? What truths do we take for granted that might be holding us back?
That is a great question, something to really think about as we keep learning and growing as investors. Well, thanks for joining us for this deep dive. We hope it sparked your curiosity, maybe challenged a few assumptions,
Yeah.
and inspired you to keep exploring this amazing world of factor investing.